There's not much to smile about. There's only one thing, his retirement account or his investment account. Last year, it was up 20%. Oh boy, we're about to wipe that out in weeks. And suddenly that one smile point goes away. And there's nothing but darkness. And when you have no hope, no place you can look and smile, that's when emotion comes into play, and fear and volatility and uncertainty. And that will help the monetary metals. And also it will impact the day-to-day life of average American, just like the 2008-9 collapse did, finally late in that bear trend, we had in the street type of pain, personal pain, not just stock market. And I think that's coming.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Michael Oliver. He's a regular guest and very well liked and well respected, and he's also the founder of Momentum Structural Analysis. So, Michael, thanks so much for coming back on the podcast.
Be back, Anthony.
Yeah, looking forward to the conversation. Things have been pretty hairy the past few weeks, especially since Trump's his inauguration. It's actually quite interesting. But yeah, I'd be interested to hear what your thoughts are on the economy and markets in general.
Well, there's one factor we were waiting on to help provoke more aggressive movement in all markets, and that is the breakage of the U.S. stock market bubble. There's also a couple others around the globe. Japan is a bubble by our definition, and so is India, Sensex index. So it's not just the U.S. But the bubble has broken our initial trigger levels. Did it early, actually in January for the S&P, but the NASDAQ 100 held off. It just wouldn't break our key level. It broke it a couple weeks ago, well above where we are now. And that breaking that level told us that the bubble is going to start to unwind, meaning we're going to start a bear market. This is not a correction. Not that it has to crash. In fact, bear markets rarely commence with crashes. You go back through history, I think 29 is about the only one that started with a crash. And sometimes they didn't even have a crash. 2000 to 2002 in the S&P went down 50% and never had what qualified as a crash. Just bloody downside, layer by layer. So anyway, we think it's begun. Now, why is that important? It's important because it causes movement of money. Investor money, that especially late investor money, which is a lot of it, a lot of foreign capital as well, to flee that market and go elsewhere. And if you go back through history, and we've done studies on it and produced reports showing the evidence, gold is always the place to be, period. Now, 29 to 32, when we had the collapse then, you couldn't buy gold in the U.S. Roosevelt, it was illegal, like a drug, okay, whatever. But you could buy Homestake Mining, the biggest gold miner then, and it went up like 1,000% during that time. Okay, and then since like the 70s, when you had the bull market peak of the stock market, which I finally ended in a crash in late 74, gold went up during that time. In fact, during that crash period in the stock market, gold exploded. That's when it went up to $200. 2000 to 2002, during the dot-com bubble break, which was hardly a bubble compared to what we have now. I would call it, 1/10 the size of this bubble. Gold went up. In fact, gold went up from 2000 to 2011. It didn't just go up during those couple years. And, again, 2007 to 2011, 2009, the stock market went down and gold went up during that time. Yeah, there was an interruption in gold's upside that occurred simultaneous with a crash event that occurred in the stock market, which was a full year off of its high before the stock market ever had a break that you could call a panic crash. And gold participated in that for like 1 month and immediately turned around and resumed its bull trend. So what we've got now is the beginning of that breakage and the movement of the money. And another factor is going on that we technically identify, and that is the foreign exchange markets. If you look at the major Forex markets, like the dollar index, which is an upside down version of the euro and the yen, basically 70% of it is the dollar index. it's been in a dull 7% basically range for over 2 years, where it's been the quiet one. In other words, there's a major asset category over there that isn't doing anything, not provoking movement in any other market. It is now breaking below our annual momentum trend structures. Now you look at price and you say, well, it's not breaking anything. It's just sort of in the lower third of the last 2-year range. But for us, it's breaking a multi-decade uptrend on annual momentum of the dollar, which tells us we're about to commence a significant downside in the quiet one. This time it's going to be noisy, but to the downside. So that's another elemental factor. And it's interesting that it's occurring simultaneous this month with the breakage in the NASDAQ 100. So it's a double whammy. And that's a double impetus fuel for gold. So anyway, I think it's going to be an interesting year, 2025. And I think it's going to be far more volatile than what we've seen in the prior years. And for the monetary metals, I think instead of this staircase arm wrestling process, which has been upside, you're going to see an acceleration, a dramatic acceleration.
Yeah, okay. So a lot to unpack there. But you mentioned at the start that a lot of markets are in a bubble or were in a bubble. How do you classify that? What are the metrics that you use?
Let's do this. You can always say, oh, the stock market went up because of a good economy. Okay, well, they always say that. Okay, but look at an M2 chart, money supply growth in the U.S. And over the last 15 years or so, it's grown more than any prior 15-year period. But look at the federal funds rate chart. Go to the St. Louis Fed site and look for Fed funds. And go back 50, 60 years. And you'll see that at 2009, they took it down to like zero. Okay. Free money. Okay, great. We're on drugs. Let's buy stuff. Okay. They kept it there for like a decade, and then they raised it, prior to the COVID event. And then they quickly snapped it back down to zero again, fuel the fire once more. And then they've raised it. But even the recent raise that we've seen, are starting to drop now. But the rise we saw a year ago, even that is trivial when you look historically at Fed funds rates, getting up to where we were like 5+%. Who cares? It's like still in the very lower portion of history. So we've had free money for 15 years. And when you look at the stock market, instead of like 1923 to 29, 6 years of bull trend, look at .com, we signaled it in 94. So it went up for about actually early 95. So it went up for 5 years and it collapsed 50% in the S&P and 82% in the NASDAQ, which was the representative of the .com. But it was only 5 years. And the advance in the market back in 23 to 29 and mid 90s to 2000 top was only like, doubles and triples. Okay. And the span of time was like 5 years or so. And then go back and look at the low in 2002, October was when that bear low occurred. And it took it 5 years to get up to 2007 to get back the S&P back to its old high again. Took it out by just enough to take it out. This is in October of 2007. So there's a 5-year bull market, exactly from October 2002, October 2007. And the Fed started cutting rates then, but it didn't help. The market came down, but it was only a 5-year phenomenon. And the S&P like only doubled. Okay. And yet when it went down, we deemed it a crisis. It was a mortgage crisis. This one is 15 years old. For the S&P, it's like a 9-fold advance from the 2009 low to the recent high, and an 18-fold advance over the 15 years for the NASDAQ 100. So there's no time comparison and there's no dimension comparison of this bubble to the prior ones. And to the extent that it was caused, highly likely, by monetary policy of central banks, not just ours, that created effectively false concepts, false decision elements. One major element in anybody's commitment to a business deal, to mortgage a new mortgage, build a new house, add to a factory, build highways in the state. All these commitments are based on certain factors, but one particular one is the cost of money. And if you're deluded into thinking the cost of money is free or next to free, then you made a mistake. And the error will be ripped open and exposed. And that process has begun. And that money will go elsewhere. And when the central banks try to panic and respond to that crisis, which will be a crisis, the data points that the Fed likes to claim they're looking at will suddenly go south quickly. That's the way it happens. They don't go south before the market goes down. The market goes down, then they really go south. Then the Fed has an excuse, the ECB, the BOJ, to go crazy again. Only this time, as was the case 2007 to 2011, or et cetera, in all these cases where gold was the alternative, gold was fueled by that monetary reaction. So it's a perfect setup. Only this time it's much bigger, much more dynamic, and the consequences in the real world will be far noisier. That's our prediction.
Yeah, and have you been surprised, I guess, how long it's taking for the recession to come? Because I think it's something that we've talked about maybe a few times, or maybe not recession, just the market crash, and it's sort of held up quite strongly.
Yeah, well, we're getting down there in the area. We think the first support level for the S&P and the NASDAQ 100 will be at an idiot price level. And I call it idiot because it's back. You go back to the 2021 high in NASDAQ and the 2022 high in the S&P and draw a line across. Do that on your screen. And when we get down there, there's certain momentum reasons that we think that could be a bounce level. Now that's, we're talking 4,700, 4,800 S&P. So that's not crash dimensions. A crash is 30 to 35% in a couple of weeks. 29, .com. No, there was never one of .com. Excuse me. In October of 2008, for example. And also the COVID event was a crash event. It was in a couple of weeks, you had a 30% drop. I don't think you're going to have that this time. I think you're going to have a layered double-digit type painful decline, but not a crash event. And as we've already seen, those who are persistently holding to the false narrative that if the stock market goes a downside big time, gold and silver go downside. Baloney. History does not prove that. There are a few rare examples where you can find an instance, but they're instances. They're not the major trends. And I think the downside in the stock market, and we've seen it for the last several weeks, is quite serious. And yet gold has gone up and silver has gone up sharply. And the gold miners have gone up even more on a percent basis over the last 3 weeks. So it's a falsehood. And that will help fuel gold and silver and the miners. And frankly, there are not many other alternatives out there that you can find that look like they're moving opposite to the stock market. T-bonds are temporarily. I think they'll continue to advance, meaning yields will drop a bit on the long end. But I don't think it will persist much beyond a quarter or so in terms of time. But anyway, we've unraveled a lot of things, and once they get going, they cannot be reversed by Fed policy. We see at every bull market peak in the last couple decades, they cut rates, all the way down, and the market yet implodes. So I think that's where we are, except we're at a more historic point.
Yeah, it's amazing to think that we could be there, and yeah, as you're saying, it could be a lot of faster crash. Do you see this something being very quick and very, or do you think it'll take a bit longer?
I think it'll be in sharp layers, but I think it'll be in layers.
Okay.
And I do think that level I provided, that 4,800 on the S&P, and meaning back to the old 2022 high, and for NASDAQ like 17,000, NASDAQ 100 I'm talking about. That's a point you could have an inflection, or an inflection that people say, oh, look, it's holding, it's holding on the old highs. You buy those old highs, et cetera. And it could be diluted for, a month or two. You could have mini MINI rallies between now and getting there, but I don't think there'll be more than, a several day phenomenon. But you get down there, I think you could get a pause that holds for a bit. But at that point, you've already done huge damage to not just the market prices you've wiped out last year. What does the average investor smile about now? There's not much to smile about. There's only one thing: his retirement account or his investment account. Last year it was up 20%. Oh boy, we're about to wipe that out in weeks. And suddenly that one smile point goes away, and there's nothing but darkness. And when you have no hope, no place you can look and smile, that's when emotion comes into play, and fear and volatility and uncertainty. And that will help the monetary metals. And also, it will impact the day-to-day life of average American, just like the 2008-9 collapse did. Finally, late in that bear trend, excuse me, we had in the street type of pain, personal pain, not just stock market. And I think that's coming. And I think that the political forces at work right now will have helped exacerbate that, not cause it. I know that the one side of the equation here is going to say, see, when he became president, market went down. Well, it was going to go down anyway. Our technical analysis said we didn't care who won. She could have won, it wouldn't have mattered. You're still topping out, you're going down, and that bubble's going dark. And she would have been blamed for it, or now he gets blamed for it. So it's going to be an interesting year. And we argue that the best place to be, especially over the next year, maybe even beyond, is going to be in the monetary metals, particularly what people perceive as the underperforming aspect of that arena, the silver and the gold and silver miners. We think they'll vastly outpace gold in terms of percent gain.
Yeah, and I guess they do have some sort of tailwinds as well. So there's oil coming down, a large input to a lot of the the production. Gold and precious metals are still at a pretty good price.
Another area to watch that will go up, and you mentioned oil, but oil is a laggard in that sector right now. In late 2020, after gold had already doubled from a low at 1,050 and gone up to 2,070, so it almost perfect double between late 2015 and mid 2020. During that same time, the Bloomberg Commodity Index went down to historic lows. It had been in the 237 in the year 2008. The Bloomberg dropped down under 60 in 2020, despite gold having doubled during that several-year period, 2015 to 20. Commodities still went down. But then in October of 2020, we put out a report. We technically identified an upturn in commodities that would cause what we determined to be an explosion. And sure enough, commodities exploded. Basically, all commodities. You could throw a dart. It wouldn't matter which one. Oil led the way, percent-wise. Grains went up. Sugar went up. Everything basically went up. This time, after the pull, by the way, governments like to blame high energy prices on the Ukraine-Russia event that started in February 2022. Surprising many when it started, by the way. A lot of people were up a month before, so no, it's not going to happen. The market, oil had already gone from $10 to 130, basically, before that ever happened. Commodities peaked 3 weeks after that war began. So when the war began, commodities were topping out, and they went down through 2023, 2024, and into this year, where the Bloomberg Commodity Index, after having gone to 140, after that low under 60, so it more than doubled, but still was cheap because the old high was 237. It was 140, okay, at the peak. It pulled back under 100, but basically it's gone dead for over 2 years. Now we're trading at 105 as we do this interview. No big deal. When you look at a price chart, that doesn't mean too much. Our momentum metrics say we've already broken out, but if you close over 105 at the end of a month, this month, we're trading there now. If you close the month out over there, there's another leg coming in the commodity upside. In other words, they're still cheap historically compared to their own prices. They're cheap compared to the S&P. They're cheap compared to gold. And they will follow gold this time around, unlike what happened between 2015 and 2020. They will follow. Now, again, that's an upset to Trump because, he's promised to keep prices down. Well, I'm sorry, there are factors in play here that are cyclical and bigger, caused by factors that have been in play for decades. And partly because commodities are vastly underpriced as well. So when money moves from high risk, low reward into low risk, higher reward, commodities will be a place they'll look. And I think a lot of stocks that are related to commodities, such as oil-based stocks, base metal-based stocks, ag market related stocks, fertilizer and so forth, will do quite well this year. Oil is lagging right now. It's one of the weaker components of the overall commodity complex. It's laying near the multi-year lows in the 60s, mid 60s. But you get back up in the low 70s again next quarter, it's going to join in with the Bloomberg, in which case you're going to see rising commodity prices again. And no doubt helped fueled by money leaving the stock market, but also because the central banks are going to respond once again by printing, and that will go somewhere. And remember the late 70s when we had global recession, or worse even, global stagflation, they called it. Commodities exploded and the world was in a recession. Commodities followed gold at that time. So anyway, that's another area to be looking at, but it won't compare to the percent gain in the miners and in silver.
So if I maybe take a step back, it sounds like do you see the dollar then coming down as well? Because I think normally that's sort of the relationship that we normally see.
It's below our breakage point right now. So if you close the month out where the dollar index is now, which is in the 103s, our breakage point is below 104.28, I think is the number. So we're trading below it, and you close the month below it. I think we've begun a major downside process. The public won't get upset about the dollar breaking until you get under 100. Because if you look at a price chart for the last couple of years, we've made repeated lows on the dollar index around 100. An idiot number, big round number. They defended. We got up to 110, suddenly down to 103s. You get back to 100 again, they're going to blow the bottom out of it. That's when the public will notice it. We're arguing that under that 104 trigger level, it's begun. So momentum usually speaks first, and then price gets the message later. But yeah, that will become a factor again. And put it this way, if you're a foreign investor in the U.S. market, you bought stocks here in dollar terms. Okay, so it's not just a factor, did your stock go down, but is the dollar going down too? So you're whammied on both sides. So that could become a factor. And foreign investment in the U.S. market is really at max levels historically. So that could help exacerbate the stock market decline.
Yeah, okay. That's so it sounds like economically you think it could be, at least if that were the case, it could be quite a bad 6 to 12 months for the US in particular. Couple of years.
Most bear markets, if you go back 29 to 32, there's 2.5 years, 2000 to 2002, 2 years, 2007 to 9 was like 2.5 years. Most of them get pretty much done in a couple of years. The issue isn't that. It's the dimension of the drop, how much percent drop. And, again, in the dot-com era, and NASDAQ went down 82%, where the S&P went down 50%. But the other issue is this. Once you enter the gates of hell and you go down, even when you make a low, it takes a decade or more to get back to the high. If you look at NASDAQ 100, for example, made its peak in early 2000. It took until 2016 to even get back to the nominal price high of 2000. So you wasted 16 years just to get, so if you didn't get out in 2000 and you rode it out, it took 16 years to get back to it. And that's nominal, because during that 16 years, the decay in the money unit was like 50 to 60% value lost due to the increased supply. S&P took 13 years, making a high in the mid 1500s in 2000. Again, in 2007, made a high in the mid 1500s. It took until 2013 to finally get back through the 2000 and 2007 highs. So that was a wasteland for 13 years in price, up, down, up, down, up, down, if you didn't get out at the right place. And even in nominal terms, you might be back to break even at the old 1500 level in 2013. But in reality, in real terms, you weren't back to break even until probably the 2022 high, in terms of real dollar value of that asset. So that's the issue. It's not just the issue of the drop, the duration, but it's the real world consequences that get exposed by the stock market breaking. Factory closures, collapse in government debt, which is now an issue on the table, not just here, but elsewhere. So suddenly we've got a debt issue that is not a mortgage issue this time. We've got the global government debt issues. And so that could play in a huge way, especially to favor gold.
Yeah, so if we go to gold now, I know we've touched on it quite a few times. The last year or even two has been extremely beneficial for the actual asset, but then the miners have sort of really really lagged. And there's been this sort of theory that that's because, foreign central banks have been, and foreign individuals in China and India and other countries have actually been buying up precious metals. And then while the West has sort of sold them as well as selling the equities as well. Do you buy into that, or do you think there's been another reason for
We
this
don't
disconnect?
pay attention to those
Okay.
news stories that are, whether they're true or not. There's a bigger picture here, and it's the ongoing monetary decay and a crisis now in fiat currencies and debt of governments that is far bigger than any of who's doing what now and when. Gold was going to go up whether China got it behind it or not. And they're now printing money like crazy to help support their market. By the way, their market is not a bubble. The Shanghai Composite is only double the price it was in 2009. We got the 9-fold and 18-fold. So now they're back to printing money, but to hold their market up, and they will go down economically, I'm sure, if we suffer a global downturn. And our metrics say that the Nikkei and the Sensex have now broken as well. So we've got major countries around the world that have signaled the onset of bear markets. And with that will come economic downturns very rapidly. So everybody's probably going down economically. But the question this time is, we do this over the decades, and it seems like boom, bust. Bigger boom, bigger bust, bigger boom. This time it's going to be, I think, total cleansing, where many institutions, many economic government assumptions, investment assumptions are going asunder, where people will say, geez, it's different this time. I don't just mean how much the stock market drops, but the other realities that will be exposed out there. And a lot of people aren't talking about them. Like right now, even just looking at the market, people are looking primarily, well, what's NVIDIA doing? What's the big seven doing? They need to be looking at the financials, the banks again. And we're looking at them, and we're also watching commercial real estate, not residential home builder stuff, but commercial real estate. Because those arenas look very vulnerable to us to creating a sudden headline type crisis off to the side that nobody's talking about. And you know how those can pop up. All of a sudden, it's not a regional bank. It's, oh gosh, one of the biggies. He has a problem or something. Or a major asset management firm is suddenly in deep trouble. Now, another arena that I think is moving with the market and with the NASDAQ 100 in particular is the Bitcoin situation, the crypto market. We think it's topped. We think it is a major bubble. We think it could break savagely already. If you just look at what's happened, we've gone from 110,000 Bitcoin down to 76,000. Whoa, in a matter of a couple of months. That in alone is a collapse. We rebounded up to 90. Right now we're trading about 80,000. I'm arguing you get back down to that low we just made, 76,000 area. Again, they're going to pull the plug. In other words, you're going to see even more serious drop. The problem is that is a heavily retail invested market. It's not an institutional invested so much. Now, there's some institutions that have produced products like ETFs in that arena. So they've got commitment that way. But it's a heavy speculative retail, highly leveraged market. And so that could cause a lot of financial pain, which could, because it's moving in sync. If you'll look at like month to month on Bitcoin and NASDAQ 100, they look like brother, sister, except recently a far more severe drop in Bitcoin. But that's another factor that's outside the stock market that is now in sync with it. And quite often these things cascade, and it's the thing off to the side that you're not looking at that suddenly smacks you in the head. And you say, oh gosh, I didn't think about that. Expect it.
Yeah, it's definitely, as you said, it's the wealth effect, and I think that's Bitcoin's down 30%. A lot of the other cryptos are down 50-60%.
Yeah.
People are struggling in that market, but gold, yeah. So you think you see it doing well, and as well as the gold miners.
Well, the thing I've put out many times in interviews is that if gold went to 8,000, it's no big deal. Why that number? It's not a projected target or anything of the sort. All I've done is go back to when gold was legalized, 1975. You had a couple of bull markets that were eightfolds. From the mid 1976 low to the 1980 high was $1,003 up to $850. Okay, 3.5 years. Then over a span of a decade, you went from early 2000s up to 2011. It went from $260 to $1,920. Okay, another eightfold move. Now we have fundamental and technical dynamics that are in play that are far bigger than those periods of time. So the excuse that gold had to do that, you got the same excuse now times 10, okay? But if gold barely went to 8,000, that's merely replicating an eightfold move that you had 2 times before in the last 50 years. So if you go to a ratio or a log scale chart of gold monthly, go back 50 years, put it up on your screen, and look at what we're doing now, it looks tepid compared to those bull markets. If we went to 8,000, at least you'd say, oh, I'm doing it again. So we throw out the 8,000 number, not as a target, just saying, if it went there, it's no big deal. It's done it twice before in terms of metrics. The issue is for us, not that, because I don't know where gold's going. Go to 20,000, I don't know. I've got some good friends who are thoughtful economist type, and they think it easily go into that zone. The issue is the ratio of silver to gold and the ratio of the gold miners to gold. And we think that is breaking out to the upside, favoring them because the last several years they've underperformed gold. Actually, since the 2015 low, you mentioned the gold miners a while ago. You measure from the 2015 low to the present, gold miners are actually beating gold, even though they're not above their 2020 price high, and gold is above its 2020 price high by a significant amount. But from the bare low, for instance, in the XAU index in December 2015, low monthly close to its current price, you go back and look at it on your charts, do the math. How much up is XAU? It's actually up more than gold is, measured from its low monthly close at 1,060 back in December 2015 to the present. Yes, they've lagged over the last several years where gold has launched and they've stayed below the 2020 high in the miners, that is. They're about to blow through that. And I think the ratio, the spread relation between the miners and gold is about to go vertical, where they outperform gold in this phase, and silver does the same. And I personally, and we state this in our reports, what positions we have. My emphasis is in silver and the gold and silver miners and in silver miners. Yes, gold is the mama. It will lead the way, but it won't lead percent-wise at this point going forward. We think it will lag the other components.
Do you see this being sort of, I guess, a super cycle for these assets, or?
Yeah, I think it'll be compressed into a shorter time period. In other words, it's already been, almost 10 years for gold upside. Well, from 2000, 2011 was 11 years. And I'm not counting you. I don't believe in the annual cycles because one of them from 76 to 80 was 3.5. Okay, it went eightfold. I'm just saying that it's likely we're entering the phase that's reflective. And go back and look at price charts from, let's say, mid-70s to 1980 on gold and silver. And you'll see that most of the acceleration of the upside was compressed in about 2 quarters in 1979. So in the last 6 months of that move, it went off the page. Similarly, in between 2000 and 2010, you had an advance. And in late 2010, silver went vertical into April 2011, and gold went vertical, more so than any prior point during that age bull trend. I think we're at that point now where the bull trend will now accelerate, and you will not see this arm wrestling staircase full of doubt type advance. You'll have a vertical type action.
Yeah, it'll be interesting to see. So, Michael, thanks again for your time today. Really appreciate you coming on. I think it's sort of like 5, 6, 7 times probably now. So we've
this is the dramatic time. I bet next time I'm on, we'll see dramatically higher prices.
Yeah, we'll have to wait and see. But thanks. Yeah, if anyone wanted, what is one message you want people to take away from our conversation?
Well, go to our site and visit we explain our methodology, which is unorthodox. We've been doing it since 1992 for institutional subscribers and retail subscribers. But we look at all 4 major asset categories, especially this day and age. It's important because, like the dollar's been a dull asset, but all of a sudden, if it starts to get weak, it comes into play with gold. So you have to look at all 4 categories to sort of stay in tune with what's really going on. Anyway, look at the on-site and request some sample reports. Be happy to send them.
Great. I'll put that in the description below.
It's Oliver MSA. Yeah, Oliver MSA.
Yep, I'll put that down there. Don't worry. But
Thank you.
Thanks again for your time. Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, you know, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.